What are securities? So there's a classic test for what securities are. It's a combination of investor funds, passive investor funds, where they're looking for profit from the efforts of a third party, from the efforts of others. An example would be raising capital for a a startup. Investors, they have commonality. They're all the same type of investors. There's a multitude of investors bringing in money or assets, but they're passive. They're not doing anything. And then the management of the company is entrusted to use their fiduciary duties and their efforts to create value for the benefit of those investors. In the securities realm, there are really three very important laws: the Securities Act of 1933, the Securities Exchange Act of 1934, and the Investment Company Act of 1940. The Securities Act of 1933. The Securities Act of 1933 is all about offering investments to investors and what regulations there are that apply for issuers. What is an issuer? An issuer is a person or company that is issuing an investment, otherwise known as securities. The Securities Act of 1934. The Securities Act of 1934 deals with stock exchanges and sets up the platform and the requirements of trading stocks and what needs to be provided to make that happen. The Investment Company Act of 1940. The Investment Company Act of 1940 regulates mutual funds and other investment vehicles that are investing into other securities. With the Investment Company Act of 1940, you either have to be registered like a public company basically, or exempt from registration. With the Investment Company Act, the most classic exemptions from registration include real estate. It includes private funds, generally having 99 or less investors. Other exemptions include having a limited amount of securities as part of the company's holding. There's a bright line rule, meaning there's a limitation of as long as 45% or less of income and assets held by the company are securities. It is still not required to register as an investment company. For an issuer issuing investments, it generally comes down to 2 to 3 different types of assets. The first being real estate, including first lien mortgages. The second includes business startups or business expansion for operation. The third is other securities, and this is where you have mutual funds raising money through issuing securities actually to buy additional security. When we talk about equity, we're talking about ownership of stock or interest in partnerships, generally for the purpose of profits or voting. When we're talking about debt, it's generally a promissory note or a bond or a debenture where they're borrowing money from investors on generally fixed terms, meaning there's a maturity date and an interest rate and how those investors are actually going to collect. When we talk about derivatives, it's generally an investment contract representing some other type of asset. A great example is a stock option. A stock option is a contract for 100 shares of stock. The shares of stock is equity. The investment contract for the right to buy or sell those 100 shares would be a derivative contract. When we talk about issuing securities, the first issue is, are we going to register the investment or find an exemption from registration for the investment? That will be generally defined by where we expect our investors to come from, what kind of company it is, and really how much work are we willing to go through in order to register or find that exemption. To give you a couple of examples, Regulation D is the most classic securities exemption, and under this you don't have to register with the SEC, but there are certain filings that take place with the SEC. There are certain filings that take place with the states that your investors come out of, and there's also generally requirements of what kind of documentation and information has to be provided to the investors. To give a simple example, with Regulation D, Rule 506B, you're required to provide information about the management, information about the investment offer itself, and also what does a company intend to do with the money? What are they in the business to do? As well as, very specifically, how do they plan to spend the investor's fund? If it's a large enough raise, generally there's even requirements to get audited financials. Financial statements from a third-party CPA that are also required to be provided to investors. This is all really complicated and complex requirements about offering investments, which is exactly why you should always be talking to a qualified attorney about what your plans are. Again, getting back to where you're going to find your investors, how you're going to market for them, what kind of business you're trying to create or run. And as long as you have competent counsel on your side, don't worry, the process should be simple, easy, and you should be raising capital in a matter of weeks. When an issuer has decided to sell an investment, you have to decide where your investors are going to come from, meaning what kind of marketing you plan to do, whether it's social media or not marketing at all. That will direct what type of securities registration exemptions there are and what you have to do in order to find those investors and accept their money. Did you know that founders of companies can't sell out right away? There's a Rule 144 that states that if somebody founds a company and they get given those shares at that startup for at least a 1-year time period, they're not going to sell out to investors. Now, you can reduce it to 6 months if you register the investment with the SEC, and there's other options as well. So definitely talk to a qualified attorney about what options there are. But please note, Rule 144, the restricted shares, does not restrict your investors from being able to also sell their investments, and there's not a time requirement there. If you're looking at an investment, just always remember there is risk in investing. When we're talking about private investments, a startup company, you can actually lose all of your money. There's no guarantee of success. But from the issuer's perspective, I would argue that selling investments of equity is always superior to accepting debt or looking for bank financing, in my humble opinion. The reason being is with debt, there are stringent terms that if you default, you don't make a payment when due, you are now in default. You can't find other investors. You have to disclose that there are problems if you do find other investors, and there may be personal liability. Where with equity investments, there's generally a higher amount of profit that you're offering compared to debt, but there are less stringent requirements of when you absolutely have to make those payments, and it allows for the issuers to have more flexibility to pursue their growth path. Looking for equity investors is always superior to finding debt or bank loan. The reason, because with equity requirements, there's more flexibility for the issuer and promoter of the investment to do what they need to do for the business's success.